The Rebel Capitalist Show.
All right, guys, it gives me a great deal of pleasure to welcome someone that I have really wanted to talk to. He is one of my absolute favorite macro thinkers and investors. He really needs no introduction, but here he is, Chris Cole himself. Chris, welcome to the Rebel Capitalist Show.
George, it's just great to be on the show, and I'm really happy to be here.
Awesome. Let's dive into it. Everyone knows you from the Dragon portfolio, the famous Dragon portfolio. And what I've been thinking through lately, and you can kind of explain this to us, is in the Dragon portfolio, we've got the left wing as a deleveraging and the right wing is a deleveraging. And I think everyone can agree on FinTwit, let's say, that we've got to have some sort of deleveraging. The debts are just too big. The question becomes, do we get it through deflation or inflation? And that takes us to this report. And then maybe once you can describe that report, you can tell us what your views are for the next maybe 2, 3, 4, 5 years for the rate of inflation and what we're seeing with the CPI right now.
Yeah, you got it. So to kind of recap this concept for your viewers, and this is obviously a short form from what's in our papers, which are available on our website at www.artemiscm.com. But the concept is when a country, when corporations, when individuals are massively over-indebted, and we are massively over-indebted.
Right.
Both on a public government level, we have the highest deficits to GDP in American history outside of World War II. Corporate debt as a percentage of GDP at all-time highs, unprecedented levels at all-time highs. So we are massively indebted as a country. Corporations are massively indebted, and when you have this level of debt, there needs to be a time for debt jubilee in some fashion. Now, if you look across history, and anyone who's read my work knows that we're students of financial history. There's two ways to get rid of excessive debt. You can have a major deflationary collapse where you default on that debt. A great example of that is the Great Depression.
Right.
In that scenario, you had markets drop over 80%. You had volatility. The volatility we experienced in March, imagine experiencing plus 40% realized vol for a decade. That's incredible. And so that's the 1930s for you. Now, there were periods in the 30s where markets rebounded tremendously.
Right.
80% rally. Like for anyone who says, "Oh, we're out of the woods," in the 1930s, you had 80% rallies off of lows, and then it continued collapsing later on. So it's interesting to keep that in mind. Well, that's one route. You can default on your debt, wipe the slate clean. But the problem with that is mass unemployment, tent cities, all these other problems. The other way, the stealth way that you can default on massive amount of debt is you can not devalue the debt, you devalue the fiat. You actually devalue money itself.
Right.
And under that, that's what we call the right wing of the hawk, or the right tail of the return distribution. Of course, the most extreme examples of that would be hyperinflation. The German hyperinflation, the Brazilian hyperinflation. But there's actually a fantastic proxy for that, for maybe a potential reality for the US is the 1970s. Because in that scenario, what occurred is that Nixon devalued versus gold. We had the Nixon gold shock, and we fully delinked the dollar versus gold. And at that point, inflation rose all the way to the mid-teens. And in that scenario, what occurs is that instead of defaulting on your debt, you're actually devaluing you're gradually cutting away at the notional value of the debt through inflation. Of course, this is equally damaging because, if you look at the 1970s, the stock market kind of moved sideways for a while and had a drawdown of about 30%. But if you look at what occurred to the stock market during that decade after inflation, you had an over 50% loss on your portfolio after you took into account inflation. If you're making 5% in the stock market, but inflation's at 15%, you are losing money.
Right.
this also explains part of the generational challenge. There's a generational fight going on, because if you're someone who's older and you already own a home, you already own assets, what you're going to want is you're going to want the government to bail out financial markets. That's the oldest thing through monetary policy. Well, if you're a young person who doesn't own a home, who has massive amounts of student debt, you want the government to bail out markets through fiscal policy, print a ton of money, give you that money, or issue a lot of debt, give you that money. You don't care about inflation because you have no assets. You only have debt. And if you only have debt and no assets, inflation has benefited you. So I always joke about this with my parents. They graduated from medical school. They're both doctors in the early 1970s, or actually kind of middle of the 1970s. And what a great time to have a ton of debt, because you have no assets and you have tons of debt, and your debt gets eaten away by the inflation.
Right.
Across history, these are the two wings. These are the two ways out of the debt cycle, and both destroy wealth. Both are complete ways of destroying wealth. So the question at the end of the day, and the question that we try to answer through the Dragon portfolio, is we've only existed in the last 40-year period, really starting in the early 80s to now, has been one of the most unprecedented periods of secular growth in history. We started out with interest rates all the way up, 10 years all the way up at 16%, and we go all the way down to near zero, right? At the same time, these baby boomers, huge generational power enters into the economy. They enter their prime spending years. You have globalization. The 1970s, we had a very low debt level at that point in time, relatively speaking.
Yep.
So it wasn't that damaging. And so there was a tremendous amount of debt accumulation. And starting in the late 70s, taxes were actually already quite high. So we were able to lower taxes and deregulate markets and deregulate the economy. So this pro-cyclical cycle of starting out with low debt, high inflation where rates can be lower, positive demographics, positive exporting our inflation using globalization as a tool, has resulted in this incredible 40-year period of unprecedented price growth in stocks and bonds. And the entire world is operating on this idea that will repeat.
Right. That's right. Everyone's portfolio is set up based on the last 40 years being the next 40 years.
Exactly. Everything's looking in the rear view mirror.
Mm-hmm.
So in my paper, I talk about this concept, and you've done a wonderful job articulating this in your podcast and some of these ideas in your show. But if you expect the next 40 years with the last 40 years, you're going to be in trouble.
Right.
You need to prepare for this secular decline. The problem at the end of the day is you don't know how the secular decline is going to occur. You don't know if it's going to be deflationary. You don't know if it's going to be stagflationary. And the truth is markets aren't going to determine that. Policymakers are. So you almost have to read the mind of policymakers. So we have this ethos at Artemis, which is, and the main idea is do not fear, do not predict, prepare. And so the concept of the Dragon portfolio is looking across 100 years of financial history. What portfolio is able to profit off of the growth, but also profit off of the left and right tail of the regime distribution? A portfolio that can profit in stagflation and a portfolio that can profit in deflation.
Right.
We tested every conceivable portfolio and came up with this answer. And this empowers people to not have to predict. You don't have to predict in time. Maybe if you're Stanley Druckenmiller and you're a genius and you can figure out, you have that unique talent. But to the average financial advisor, to the average retiree, the ability to predict the winds of these changes are very difficult. You don't need to if you actually hold the right combination of assets.
Yeah, and that brings me to the topic of how important portfolio construction is. That so many people get hyper fixated on just trying to look around at just the shiny object syndrome and trying to determine what the price of XYZ is going to do. And they completely ignore how their portfolio works and how each asset in their portfolio plays off one another, and therefore what the probabilities are that they are financially successful over the long term. And
right.
You know, I have such a huge advantage because I started off way back in 2000 playing blackjack. It right at the beginning of when I was an entrepreneur, and it's just to train my mind to think in probabilities. But going back to the idea of portfolio construction, can you go over the Rodman story and the George Lucas story? Because I think that paints such a perfect picture as to why that thinking about the portfolio construction should be a higher priority than just trying to figure out if asset XYZ is going to go up or down in price.
You know, George, it's interesting what you said about blackjack, because when I was in my 20s and I was learning systematic trading, I trained myself on card counting.
Yeah, I did the same thing, but to train myself how to think better in business in terms of probabilities.
Exactly. Like I'm not going to go out and say that, you know, I was some expert card counter.
Yeah.
At one point I could count a deck in under 30 seconds, you know, but the point on it is to be able to think probabilistically.
That's right.
People learn that through poker. They learn it through blackjack. It's a wonderful tool to teach them. But you know, George, the Rodman story, and to talk about this, and it dovetails very well into a new paper that we have coming out.
Yeah.
It should be next week on our website. It's a little bit more of a technical paper. And actually, this paper is going to include Python code and that enables people to play with some of these tools. We're actually introducing a new tool. But you know, I imagine you're familiar with the concept of Moneyball. Right?
Yeah, the movie, right?
The movie and the Michael Lewis book.
Okay, yeah.
To recap that at the end of the day, you know, the Michael Lewis talked about how the Oakland A's had a very small payroll, and they couldn't compete in a league where there was really no salary cap with these big market teams like the Yankees that could go out and just buy any player.
Mm-hmm.
So what they did is they had to think creatively, and they looked at statistics and they said, well, what statistics correlate highest with winning? We don't really care about the player, we care about winning. And so they figured out that statistics like on-base percentage and slugging percentage actually had a much higher correlation with winning than statistics like RBIs and steals. So the market was paying these huge premiums for RBIs and ignoring people who would bunt the ball to get onto first base, even though like on-base percentage was much more effective. Well, the entire asset management industry has the same problem. And this is the problem. Paul DePodesta, who was the assistant general manager of the A's at the time, had this incredible quote. I don't know if he actually said it or they just wrote it in the movie. But the quote is that the problem is that ball clubs think they are buying players. You don't want to buy players. Your goal is to buy wins.
Right.
The problem with the asset management industry, this includes everything from institutional pension funds to small investors. Everyone is focused on buying high-performing stocks or high-performing hedge funds, and people don't think in terms of buying portfolio wins, how to make a better portfolio.
Right.
You're not buying assets, you're buying a better portfolio. And what do I mean by that? What do I mean by that? Well, the number one metric that people use to evaluate hedge fund managers, for example, in the asset management industry is something called the Sharpe ratio.
Mm-hmm.
Now, some of your viewers might be aware of this. The question at the end of the day is, what is your performance given volatility? What's your performance given volatility? Well, the problem is that lots of high Sharpe ratio assets can be put together and your portfolio gets worse. How funny. You go out and you select all of these assets that have really, really good high returns and high Sharpe ratios, and your portfolio is actually worse off.
Yeah. You buy 5 Michael Jordans, but you lose every game.
Yes, yeah. Well, I would say if you had 5 Michael Jordans, you'd probably do okay.
Well, you won't win as many championships. Let's just put it that way.
The problem is that you probably can't buy 5 Michael Jordans. You probably can buy 5 slightly above average offensive players.
Right.
And then you end up not being that good of a team. So we all know this from sports. We totally understand this from sports. Because I think anyone who's a fan of a sports team will, your favorite team goes out and buys some high-priced free agent who's got these gaudy scoring numbers. And then all of a sudden you add that player to the team, and the team gets worse.
All right.
Why is that? Well, the player maybe is not playing defense. The player maybe doesn't pass the ball, uses the ball too much. There's a whole variety of these other reasons. So just evaluating a player based on scoring average is not very effective to understand how the player affects the total team. It's no different with an asset to the portfolio. It's no different from an asset to the portfolio dynamic. So like in sports, one of the examples, the Rodman example is wonderful in this way. Dennis Rodman is the lowest scoring inductee in the Basketball Hall of Fame.
Right.
I'm going to talk, you talk about Dennis Rodman, a lot of people will have, these ideas about the guy. Data Madonna and Kim Jong-un, and all this. There's a lot of emotions about Rodman. I'm talking about Rodman as a basketball player. I'm not focusing on anything external. This is Rodman and what Rodman did on the court. So Rodman is in the Basketball Hall of Fame. He won multiple championships and was on some of the best teams and the best team in NBA history. Yet he couldn't score. The guy couldn't score at all. In fact, he was so bad at scoring that no one would even guard him.
Right.
No one would even guard him. The guy could barely hit a shot outside of 5 feet. Yet something bizarre happened when you put Rodman on the floor. When you put Rodman on the floor, the team's offensive efficiency shot through the roof. Your team got so much better. You could put Rodman on a team of mediocre scorers, and that team became a playoff team and a finals contender. If you put Rodman on a team of really good scorers, like the Chicago Bulls, which had Michael Jordan, Scottie Pippen, that team went from a very good team to the best team of all time.
Right.
What was Rodman doing? That he was a second-round pick, overlooked. The Chicago Bulls got him for barely anything. They didn't have to trade. I think they traded Will Perdue for him. I mean, with respect to Will Perdue, this was so. What did teams not see about Dennis Rodman? Well, Rodman did one thing and one thing really damn well.
Rebounded.
He rebounded the basketball. If someone missed a shot, Rodman would go up and get the rebound. Rodman was so good at rebounding that he was 6 standard deviations better than the average rebounder in the league. So let's imagine this. Even though Rodman didn't score, if you missed a shot, Rodman would get the rebound. He would give you a second chance opportunity to score. Sometimes he'd give you a third or fourth chance opportunity to score. Now let's talk about this. Michael Jordan misses a shot in the fourth quarter. Everyone's human, even Michael Jordan. Misses a shot in the fourth quarter. Rodman gets the rebound. Is Michael Jordan going to miss a second shot and a third shot?
Right.
Not. So what happened is that even though Rodman couldn't score, you put him on a team and the wins over replacement value shot through the roof. He would contribute to team winning. He would increase the offensive efficiency of the team. So in this sense, Rodman is like an anti-correlated asset. He's an asset that actually, like in investing, for example, you can have these assets that have very gaudy scoring numbers. They look really good on paper. You have long track records of success. But the problem is that when you're entering into a period of inflation or deflation, these assets underperform. You have different assets that don't really look very good on paper. You look at them and you say, why would I ever invest in that? In fact, it might have a 0% return or even a negative return. And you say to yourself, why would I even want that? But those assets make money in either the big deflationary events or the big inflationary events.
Right.
Those assets are like Dennis Rodman. And when you put them into your portfolio with other assets that make money during growth periods, they all balance out and make a better team. So the secret to the Dragon portfolio is we've highlighted investments. The Dragon portfolio, to go back to this concept, is a team. It's a team of players that work together where the sum is greater than the parts.
Yeah, right.
There are 5 components to that, as you've covered, but we'll review it. And they're approximately roughly equally weighted. The first component is like largely equity-linked assets. So like stocks. These assets go up with the business cycle, they crash when markets crash. The other asset is fixed income. That's the typical asset mix that most people have. The 3 other assets are assets that profit when those other 2 assets are suffering. Long volatility is like Dennis Rodman. When markets are crashing, long vol does really, really well. It doesn't look great on paper, but it does really well when markets are crashing. Commodity trend does really, really well in stagflation and inflation. And gold, obviously, also does very, very well during periods of stagflation. Gold went up 800% in the 70s. All these assets together, the sum is greater than the parts. So you wouldn't want a team of Rodmans, but you put Rodman with these other scorers, and the sum is greater than the parts. And the problem with our entire industry, the entire asset management industry, is that it's not measuring these effects. Professional sports, they're on it. These general managers get it. They have things like wins above replacement value for players and advanced plus minus statistics. They understand. They understand this. They've gotten burned so many times. But the investment industry is still stuck measuring the player and not the portfolio. They're measuring the assets and not the total portfolio.
That reminds me of a chart that you've got on your website, Chris, where you highlight what most people would consider a diversified portfolio. And I mean, I can't list it right off the top of my head, but I mean, you've got like 20 different things in there. And anyone looking at that would say, wow, that's really diversified. And then you have a pie chart right next to it that shows what percentage of that portfolio is short volatility. And it's like 95%. Can you explain that to the viewers so they understand that concept?
Yeah, the concept at the end of the day is that I have this phrase I've said for almost a decade now. We're all volatility traders. It's just whether we realize it or not.
Right.
What does that mean? What does that mean? It means that if you just stopped looking at assets in terms of artificial descriptions about what they are, like a 60-40 portfolio diversifies based on assets, right? Some more advanced portfolios diversify based on rolling correlations or vol. Well, the truth is that that's irrelevant. What you actually care about is how those assets perform in different environments. That's all that really matters. And a lot of assets only perform during a period of growth and stability. And that's what I refer to as short volatility. It's not necessarily a bad thing. They only perform during periods where markets are stable and there's steady growth. And during periods like March, they're losing money, or during periods like the 1970s stagflation, they're losing money after inflation. So these are what I would call short volatility assets. They're long GDP and they're based on the expectation of stability.
Right.
Long vol assets perform during periods of change. They make money during periods of change. That change could be default and market crashing, like in March, or it could be inflation, but they perform during periods of change. Well, most people think they have this diversified portfolio of all these different asset classes. But the problem is that when you enter into deflation or stagflation, all of those asset classes are underperforming all at the same time.
Right.
And they're just accentuating the same drawdowns. So like what you've got is an entire team of scorers with no one playing defense and no one rebounding the basketball.
Yeah. How does going long vol assist on a right tail or a right wing type of deleveraging? Because most people would say, Chris, I don't get that, because the market's going up consistently. How even if it's through inflation, how is that going to increase the rate of volatility?
Yeah, it's interesting. So most people look at volatility as being a pure left tail phenomenon.
Yeah.
Right? But let me give an example, and this is somewhat of an extreme example. I'm not necessarily predicting this would happen in the United States, but let's look at Germany beginning in 1919. Okay, so in 1919, the German stock market had a volatility that was very similar to where vol is today. The German stock market had a volatility of about 19%. It was a fairly stable stock market.
In what year was that, Chris?
1919.
Okay, got it.
After World War II.
Got it.
Obviously, there was after World War I. Excuse me on that. So obviously, there were these reparations they had to pay and everything else. But the German stock market was relatively stable, 19% vol, and that's about the volatility that the U.S. stock market has today. Well, when they began printing money in order to handle all of the debts and all the problems that they had, volatility started out at 19% in 1919. It would have risen all the way to 2,000% at the height of their hyperinflation.
Right.
So everyone thinks about volatility as being a market crash phenomenon.
Right.
But in a hyperinflationary environment, you end up seeing tremendous right tail vol.
Yeah.
Other examples include actually, the 1932 Banking Act. During the Great Depression, when the U.S. devalued, the U.S. devalued against gold on kind of two occasions. There was the 1932 Banking Act, 1934. You had 80% rallies in both instances that occurred over a period of under 3 months. I mean, absolutely incredible. That is volatility. Volatility is agnostic to direction.
Right.
Right or left tail. So all volatility does is ensure that something moves. So, but the other thing too is that some of the other strategies, like vol does tend to be or perform best in left tail environments, but you also have trend following in commodities does really, really well during those periods of intense inflation, because you end up, and we're seeing this now, like look at lumber prices and how they've exploded.
Mm-hmm.
During the onset of inflation, you have tremendous right tail volatility in commodities. And that can be exploited in various ways. So that's something, and we are seeing that today. We're absolutely seeing that. I mean, as I speak, looking out across the, viewers can see it, the Austin skyline, there are delays in construction projects because of construction materials.
Yeah, it's in residential too. They're laying down slabs and just leaving them because they can't get the lumber, they can't get the labor.
Yeah, we have a young guy who just bought a house. It's a new house. It was supposed to be finished this summer. It's been delayed.
Yeah. Oh, and that end with these new homes, they're putting clauses in the contract for bumps in material costs. They meaning the builders. So you could go in there thinking you're buying a $500,000 house, and in 6 months you could be buying a $600,000 house that you're on the hook for, and you didn't even realize what was going on.
Yeah, exactly. So this is typical of this is the typical thing of the onset.
And I want to also kind of, when we talk about this right wing deleveraging, it's like this crack up boom that Mises, I believe, referred to, and you just see anecdotal evidence of that absolutely everywhere, in my opinion. I think what a lot of people are thinking about right now is like, okay, Chris, we understand the Dragon portfolio, but we want to get your prediction on if we're going to get a right wing event or a left wing event, because unfortunately for the average Joe and Jane, it's very difficult for them to go long vol. It's far easier for them to go and trend follow commodities along with the other parts of the portfolio. So I want to get back to that in a second. But if you could only choose one, going back to probabilities, What do you see us going into? Do you see a 1970s type of event, or do you see a 1930s type of event in the next, whatever, 2, 3, 5 years?
Well, I'll get to that in just a little bit. I don't like to predict, but I do have a kind of view on this a little bit. And I actually see a 1987 style event. Let me explain my reasoning on that.
Okay.
I am very sympathetic to this. Long ball is largely an institutional and hedge fund strategy. Unfortunately, I scratch my head here because you can run a responsible portfolio and run a responsible, as we launch some of these ideas for qualified institutional investors and accredited investors. We do offer our products to accredited investors. But I'm so frustrated at regulators because, and I almost think the game is rigged against the average person. Because somehow these strategies, which are responsible strategies that are used by major institutions globally, should only be available to sophisticated institutions. Yet somehow an 18-year-old can buy Dogecoin or some sort of pathetic meme stock on his iPhone. So I don't understand what they're thinking. But Artemis is actively working on ways to bring some of these ideas to the masses beyond just research papers. We offer products to accredited investors. We are working on ways to bring these solutions to retail investors.
Well, that would be fantastic. Wow. That would be wildly popular.
Stay tuned on it.
Yeah, I can't wait.
We're working on that problem. So, but speaking about my view, first of all, I like I said before, we like to prepare and not predict.
Yeah.
So we like to prepare and not predict. So, but of course, I do have some views on things. So looking forward, it's interesting. You go back to 1987, and what's fascinating about that time is that inflation started the year out at about 1.5%. Actually, incredible. Actually, in some instances, lower than where it was, prior to the COVID dynamics. It's kind of incredible. Inflation started out at 1.5%, beginning in the year in 1987. What we saw was a huge, very big rise in inflation over a short period of time. Inflation went up over 300 basis points in a period of about 6 months, starting in the beginning of 1987.
I didn't know that. Why was that?
I think there was just kind of the animal spirits, and also the Fed had been cutting rates. They had been cutting rates, trying to keep this bull market going.
Okay.
Back to monetary policy, right?
Yeah, right.
So they had been cutting rates, and then all of a sudden there was this big, quick spike up in inflation. And if you look at across financial history, when inflation spikes, it moves up fast. Doesn't tend to be transitory, not big spikes like that. So as we got an inflation print the other day at 4%. Incredible, right? They say it's transitory. We'll see. But what occurred is that inflation rose 300 basis points, 3%, over 3% in a very short amount of time at the beginning of 1987. Initially, markets cheered it. Markets loved it. The markets were up 36% that year through August. Huge move up. But the problem is that later that summer, interest rates began to rise. The 10-year began to rise, coupling with inflation. And we had a 300 basis point increase in the 10-year treasury and similar increases in the cost of corporate debt. And those rose from about 7% to 10%. So this is the problem with a cheap money regime. It's like a drug addict, right? It's a drug addict. And the problem at the end of the day is that you need, a drug addict will go into convulsions and it needs continuous stimulus. Well, in this sense, it's the corporate debt that the increase in rates that began to cause liquidity season. So let's just imagine that inflation stays at 4%, right? It's not transitory. And they continue to give out stimulus money. They give it to people, and you end up having this kind of problematic inflation. Well, the bond market's going to respond to that, and the corporate debt market's going to respond to that. And you're going to start to see corporate debt yields rise upwards, if they rose 300 basis points, you'd be upwards of near 6%.
Yeah, and corporate debt, correct me if I'm wrong, is at all-time highs.
That's right. So that's the difference. So this is interesting. Obviously, if imagine mortgage rates rose that quickly and corporate debt rose that quickly. Well, this creates a liquidity seize-up problem because there are many zombie companies right now. When you're talking over 50% debt to GDP, you've got a lot of companies that would not exist if it was not for this cheap credit. Right. And these companies can exist with corporate credit spreads at all-time lows and corporate debt yields at all-time lows. If those corporate debt yields go up 300 or 400 basis points, you've got a different problem. Yeah. These companies will be effectively bankrupt, and may not be able to hold debt. So this is an interesting stat. This is a very interesting stat. You can do some back-of-the-envelope math. If interest rates rose back to where they were in the mid-2000s, in fact, if rates just go back to where they were in 2007, corporate borrowing and interest rates. Now, inflation's already back there, right? Inflation's ahead there. Inflation's back to where it was in 2007. But if corporate borrowing yields rose to that level, you can lop off 1/3 of corporate profits just based on rising interest rate payments.
And then higher taxes. And what about buybacks? And buybacks no more. And if that's what's been driving the market higher, then the market goes down by 40, 50%.
Got it. $1 trillion of share buybacks gone.
Yeah.
$1 trillion of share buybacks gone. And just like that. So all of a sudden you're going to have a liquidity crisis and a corporate solvency crisis. So we have the highest corporate debt to GDP in American history. We have the highest amount of corporations that are crowded into the lowest tranche of investment grade debt. If that debt gets downgraded, you've got an onslaught, like an avalanche of junk debt coming through the system. And when I say 1/3 of corporate profits would vanish in the event of an increase in rates back to where they were in 2007, that is actually, as my friend Mike Green pointed out, that is actually conservative because it assumes that those companies will be able to roll their debt.
Right.
Many of those companies will not be able to get access to the debt market in that scenario. So, and we're not even starting with what might happen to the home market if rates rose that quickly. So, look, the Fed knows this. Many of you don't know this, but as my friend Danielle DiMartino Booth pointed out so eloquently on this, the Fed had this plan to backstop the corporate credit markets for a long time. What's interesting is that really after they bailed out these massive hedge funds using repo markets in March, something that would quietly happen behind the scenes, they then did a backstop of the corporate debt market.
Yeah, to the special purpose vehicles.
Special purpose vehicles. Now, what's funny about this is people will be like, "Oh, the Fed bailed out the corporate debt market." You and I did. You and I did. The average teacher in Ohio or the average construction worker in Michigan, they bailed out corporate debt markets.
Mm-hmm.
And the reason being is that the Fed gave loans to the Treasury to buy that corporate debt. And the Treasury is buying that corporate debt. And what is the Treasury buying the corporate debt with? That's our tax money. We're backstopping it. Right. And what did all those corporations do with all that debt? They're on par for $1 trillion of share buybacks.
Yeah.
It's incredible. Well, how does this all tie into my macro view? Well, I actually think you get the inflation leading to another deflationary sucker punch. Because if we go back to 1987, what happened in 87? You had this booming stock market, increasing inflation, and increasing interest rates. And the stock market loved it until the end of August. Because at the end of August, the quick increase in interest rates going after inflation resulted in liquidity and solvency problems with some corporate debt. And beginning in late August, early September of 1987, markets began to struggle based on the liquidity seize-up, given the fast increase in rates. Rates go up and corporations begin to have liquidity problems as a result of that. Everything from repo markets to corporate debt to rollovers to mortgages money becomes tighter. And as a result of that, the markets really began to falter and became really illiquid at that point in time. And so then that led into a big decline, a 10% decline, that then exploded with this portfolio insurance. There's a portfolio insurance strategy. It was a systematic strategy. It was a short it was a short gamma strategy, actually. It's a short trend strategy in some ways. And the portfolio insurance caused the market to blow up and drop 20% in one day. Well, if you go back and you read the literature, everyone blames that collapse on portfolio insurance.
Mm-hmm. Mm-hmm.
Portfolio insurance, the way I like to look at this is portfolio insurance is like the nitroglycerin that caused the fire to explode. You could have nitroglycerin sitting, I could have a barrel of nitroglycerin sitting in my office, highly explosive.
Right.
Sit there for years on end and not explode because you need a fire, you need a flame. Well, what happened is that the fire started in the early part of '87 with the increase in inflation, the rapid increase in inflation leading to a rapid increase in interest rates. And that was the fire. That caused a liquidity seize up that then hit the nitroglycerin.
The portfolio insurance, yeah.
And that caused a massive explosion.
Mm.
Well, today, the problems are like that, but just even worse. Instead of portfolio insurance, we have $3 trillion plus of equity-linked short vol products out there that have only been enhanced based on the irresponsible actions of the Federal Reserve. Portfolio insurance at the time in '87 was only about 2% of the market. This global short vol trade, just focused in equities alone, is anywhere between 8 to 14% of the market.
And when you talk, what are you talking about specifically, Chris? Give me an example.
This includes strategies that delever whenever there is an increase in volatility.
It's like a risk parity.
A risk parity is an example of that.
Okay.
So risk parity is one element, and there's many different layers of this.
Okay.
It could include everything from risk parity to vol targeting. It could include short volatility strategies run by institutions. In fact, it actually another framework in that is the share buybacks. Mm-hmm. The share buybacks, actually, believe it or not, most people don't know this, but the way share buybacks are implemented is literally through a short vol trade in the way that they're implemented through banks. So that's in many ways, like there's a literal or a true explicit short vol component to the share buyback framework. It's a little hard to go into that in detail on something like this. But the point being is all of these strategies have one thing in common, which is that they delever very, very quickly when there's an increase in volatility. That's a big problem. So that explains why we have like the violent move that we had in March. Because when all these strategies have to delever at once and there's no liquidity, all hell breaks loose.
Right.
So the problem is that existed in '87, but that is even bigger today than where it was in '87. Some of it's blown off after March, but they just reloaded it. And so if you get this big move higher in interest rates and inflation, that will cause corporate solvency problems and will cause liquidity problems. And anyone who's been reading my writing, we talk about the unholy trinity. What is the unholy trinity of markets? Solvency is one leg of that. Illiquidity is the other leg of that. And the top of that unholy trinity is volatility. So what happens if rates go up 300, 400 basis points very quickly? You're going to get solvency problems because of the difficulty to borrow at higher rates. The solvency problems will lead to illiquidity problems. And that will lead to volatility. And the higher volatility ignites the nitroglycerin of the global short vol trade, which can result in another very violent move. So I would not be surprised and this is what makes this so difficult. We may get this massive stagflationary push higher. But the thing to look out for is the velocity of interest rates. Now they've risen a good 100 basis points very, very quickly. Inflation obviously has risen much more than that. But if inflation stays where it is, and you get rising corporate borrowing rates, this will result in an illiquidity problem that can cause a deflationary pushback on markets.
As far as asset prices, not consumer prices.
That it actually could be both, because the consumer prices
Okay.
might be favored. Yeah. But so the question, this is what I expect. So, like I say, the way we run our investment strategies, the way we try to put our clients' portfolios, we don't care. We want to prepare for all the scenarios, right? So, but I think this is what makes this so difficult. The question as to the future is, if we get that inflationary punch, the Fed can't do much during that inflationary punch. If inflation's running hot, they can't come in and save the day, really. They're limited to some degree. But if you get that inflationary punch and a deflationary sucker punch, what happens then? It's a policy choice.
Yeah.
That's the thing no one can predict, really. You know, it depends who's in control, depends what they want to do. But do we go full all in MMT at that point? Do we go full all in handouts? Do we print money and do fiat, and do we make the Fed's balance sheet legal tender? Given the income disparity and the social problems, I think anything is on the table.
Yeah, so do I.
This is what makes this so difficult.
What would you say to someone pushing back, saying, "Okay, Chris, I get the high interest rates. What would that would do to the markets? But wouldn't the Fed come in and try to institute yield curve control?"
Yeah, I mean, I think they can, you know, to some degree. But here's the problem, right? This is one of the things I get pushback on that question. You know, well, okay, they're gonna try to keep rates down. They're gonna print money to keep rates down, or not? Right. It's not money printing, but it's Fed balance sheet expansion, right?
Right.
Well, are they going to do that when inflation's at 5%? They could. I mean, their credibility is shot as is, but it's going to be really interesting to see. Like, if inflation's at 4 or 5% and consistently staying there, are they going to be able to come on in and expand the balance sheet at a continued unprecedented level and do yield curve control and continue to support the corporate debt market? I don't know. You know,
and even if they can keep the yield curve down a little bit at the long end, does that work with the corporate bond market? Because the corporate bond market, you know, that's more of a market price where they're like, okay, well, I don't care if the 10 years at 2%. I know damn well that inflation's at 10%, and I'm not going to lend to that corporation at 4%. Because I know that I'm going to be paid back with devalued dollars, regardless of where the Fed wants the 10-year to be.
Damn right. That's exactly right. So, you know, going back to what Mike Green was saying, when I gave out that stat, that back of the calculation, where I said if rates went back to where they were in 2007, you could cut corporate profits by 1/3. And if they went back to where they were in the 70s, all of corporate profits would be taken up by higher debt payments. However, that's optimistic, because as you've kind of eloquently pointed out, you know, there's two components to corporate bond yields. There's the interest rate component, and there's the credit spread component, based on the credit worthiness of the company. So these calculations, where I say 1/3 of corporate profits could be wiped out if rates rise enough, it only assumes that interest rates are rising. It doesn't assume expansion of the credit spreads. But if there are those problems, you'd expect credit spreads to expand. Yeah, which is really, really interesting. So that's
that's a generous word, I think. Interesting. Yeah. So do you think, let's say they can't get inflation? This is something that I've thought about quite a bit. And I mean, you're someone that really understands the monetary system a lot better than most people. So you understand how prior to, let's say, prior to what we've seen now with this marriage between the Fed monetizing the debt and the government, you know, Janet Yellen issuing the bonds, we had the commercial banking system that was responsible for creating the majority of the dollars through additional loans. Someone borrows $500,000, that's an additional $500,000 that did not exist before. And that's how you kind of have this fluctuation with M2, if you want to believe those statistics. Well, now we've kind of moved into this hybrid type world where the government is deficit spending, the Fed is monetizing it. Therefore, on net balance, when since they're not sucking the dollars out of the system, they're just putting them back in. We see M2 shoot through the roof. But at the end of the day, the Fed is sitting back saying, okay, we understand that the dollar was really controlled by the banks, not us, prior to what's been going on. Now we understand that it's all fiscal. So the control of the dollar to a certain degree is the government. Well, we don't really trust that. So the only way that we can take back control of the dollar is to have a central bank digital currency. So everyone can have an account with the Fed. And as Dr. Lacey Hunt says, we can take bank reserves and then turn them into legal tender. So we're the ones that are in charge of additional lending and who gets those loans and how many loans we put out there. Therefore, how many dollars are created. Do you see a world where that's even a possibility if we go into a Japan type situation where the Fed or the government just can't get the long-term inflation they need, such as we get this inflation spike, then a sucker punch lower, and then that's what they revert to as a solution, quote unquote?
Yeah, I think it's all on the table at this juncture because and it's hard to necessarily speculate. And a guy like Lacey is who's actually down the street.
Yeah.
Way more of an expert than I am
on
monetary. And Danielle DiMartino Booth is way more of an expert on monetary. But I would say at this point, what's interesting about this is that I would expect that during that stagflation and then sucker punch back, if that occurs, we go through a major crisis, you may see the entire system be challenged for the first time after post-Bretton Woods. And at that point, it's all on the table as to what they determine, what they come up with.
Right.
So there could be a whole multitude of like from the ashes of a system comes a new creation, and that I think we will see that, and that in some capacity. It's hard necessarily to speculate on what will emerge from that. So our focus is really just making sure that we have a core of asset classes that can survive for any level.
That investors are prepared for any situation. Yeah.
Exactly. I mean, it's interesting because you go back across history. It happened in Russia. It happened in Germany. That's when the system gets out of control. When the final debt jubilee happens, they usually just wipe their hands clean. I mean, Germany was actually hilarious. They're just kind of like, well, the old Reichsmark is done, and we're going to issue this new one that's backed by the property of the U.S. government. So could we have some sort of a system emerge around a government-backed cryptocurrency? And obviously, they're obviously looking at releasing ideas on that this summer. That's recently announced. I think absolutely, they could be preparing.
Yeah, it would be all about restoring confidence, and it's so hard to determine what actually would restore confidence in a situation that we don't really know what it looks like.
That's right. Yeah, that's absolutely right. And I think what's interesting is that they are not stupid. They're not stupid. They can't necessarily say what a problem that the world has been created. But if you look at the way they reacted in March, they had that game plan planned already.
Mm-hmm.
The biggest lie is that this recession was a COVID thing. That's the biggest lie. Because if you go look at it, corporate borrowing rates were blowing out previously. They actually began expanding their balance sheet in the fourth quarter of 2019. I mean, go look at it. They were expanding their balance sheet more in 2019 based on repo stress and credit stress than they were during the early part of 2009. So the stress was already in the system pre-COVID.
Mm-hmm.
So they were planning this corporate bailout plan way ahead of COVID. Then COVID hit, and it provided this incredible excuse for the unprecedented actions. But so I would not be surprised that they are trying to plan the next iteration of this scenario. How to guess that and how to play that and how to predict that. You can kind of read the tea leaves. I think my focus is more just trying to imagine the different probabilistic scenarios.
Yeah, right.
And to create the best team that can meet any of those challenges.
Yeah. So on that note, when is the Moneyball paper going to be out? That's so cool.
That's going to come out probably next week, actually. So, and we're going to introduce a concept called we call it coal wins above replacement portfolio, and that's called CWARP for short.
Okay.
Yeah, CWARP is what it is. And what this is like in sports, they have wins above replacement value, which is an advanced metric to understand how much a player helps a team. This is going to do the same thing for people's portfolio. This will measure, it's a one-stop, easy to calculate number, and we're going to provide Python code to help people with this that will enable individuals and allocators to understand whether or not an asset helps their overall portfolio, both on left and right tail levels. So we're really excited about that paper. It's going to be a little bit more of a technical paper. And we've already, actually, there's a big data group called Allocator, which actually evaluates hedge fund strategies that is owned by Morningstar that has agreed to already begin implementing this CWARP metric alongside traditional metrics like returns and Sharpe ratios. So I think we're pretty excited about that. We actually think that this could be kind of a revolutionary or interesting way for people to construct portfolios in a smarter way. So that'll be really intriguing. And we really say, like, in this framework, you want to build the best team. You want to build the best team so that you can meet any challenge without needing to predict the challenges.
I think that's the best takeaway for every investor, regardless of their level of sophistication right now. You've got to think of this as far as your portfolio in terms of building the best team, period.
Yeah, and that requires like a little bit of thinking outside the box, because like just relying on passive investments in a classic 60-40 portfolio, that will not save you. Those portfolios,
that's short vol.
It's a short vol, short correlation. Those portfolios dropped 80% in the 1930s, and you had huge, more than 50% declines in those portfolios in the 1970s. But we talk about these esoteric strategies like long volatility and commodity trend. I've got a friend who has rental real estate properties, so he owns a whole bunch of homes across Texas, and he rents those out. Well, I sat back and I said, look, you're going to be worth, if this stagflation thing occurs, you're going to be worth $100 million. I don't know what $100 million is going to be worth, but like,
it'll get you a gallon of milk.
yeah, exactly. And the reason I said this to him is that if you looked at what performed in the 1970s, well, and this also performed in Germany, like you took out debt, using that debt and bought a physical asset, and you rented out that physical asset to people needing a home or apartment. Well, what ended up happening is inflation goes up, the debt levels end up being taken down in terms of the erosion of inflation, but you're able to raise the rents in accordance with inflation and wage increases. So it's interesting. Like commodity trend is a very esoteric strategy. A good strategy that performs during periods of inflation or stagflation. It's performing this year very well. But like somebody who maybe isn't an expert on commodity trade, you could actually have a strategy like that where you use some level of debt to finance real assets that have an income component that keeps pace with inflation.
Yeah. 30-year fixed rate mortgage. If you've got a house, if you got debt, make sure it's 30-year fixed rate.
That's right. That's exactly right. So people should think about their homes within that context as well. So it's important to be creative in the thought process. It's fascinating that like if you look at the LA sports teams, who owned all the LA sports teams? They were all guys like Jerry Buss and Donald Sterling. All were doing multifamily real estate through the 1970s.
I didn't know that.
Yeah. It's not a coincidence because that was a great era for that particular type of strategy. You know, in a deflationary environment, you know, owning optionality, owning long ball, it's a little harder to get that exposure. But you know, finding people that can or being able to implement that in some type of way, portfolio insurance, it's tough to get that type of insurance, type of dynamic, but it is powerful. Yeah.
I've got a lot of people who watch this channel that are accredited investors, let's say. So if they're interested about putting money to work with you, I don't know if you've got any funds that are open, but if you do, where would they go? Would they just go to your website, or how do they get a hold of the right person?
Yeah, if people are accredited or QEPs, you know, we certainly welcome them to come take a look at our website, and if they're interested in what we do, you know, they can always contact us to that effect. And also, anyone's able to come to our website and look at our research.
Yeah,
we are looking and actively searching for ways to provide this to retail investors. I'm very, very upset in some ways about the regulatory environment and the limitations on it. It doesn't make sense to me because it almost feels kind of rigged against the little guy. You know, I talk about this concept because in the Rise of the Dragon paper, because it's like a Greek tragedy where you can see what's like in a Greek tragedy. You have a hero, like a tragic hero like Oedipus, and the hero is warned by some Cassandra as to what's going to happen. And the warning today, I think we all see it. The system's changing. We don't know exactly how it's going to change, but there's going to be a huge period of secular decline and wealth destruction. And how that comes, we don't quite know, but we know it's coming. So the problem at the end of the day is the Greek hero doesn't heed that warning for one of two reasons. Either the hero is unwilling to, maybe has too big of an ego, is unwilling or unable. Right now, the unwilling they have the ability to do something about it, but they're unwilling to, are the massive, big pension institutions, which are incredibly underfunded. Yeah. Incredibly underfunded. You know, as we've kind of shown out in some of our research, the current pension deficit is close to $2 trillion. But that's assuming you can get this like 8% return. Well, if we go into a deflationary environment and the return is something more like 4 or 3% a year, those pension deficits could balloon upwards of $9 trillion.
Yeah.
And so that's a huge, huge problem. So it's also one of the reasons why I think the government may just continuously put the pedal to the metal and why stagflation could be a reality, you know, regardless of the swings. Well, they're the unwilling, though, because they're stuck in these 70-30 portfolios of stocks and bonds and equity products that are not really well diversified. In some instances, they're just too big to do anything about it. You know, the people working in these institutions are not stupid, but if you've got $200 billion, it's very difficult to put all that money into long ball or CTAs. It's hard to allocate that.
Right.
And even if they're not that big, they might be really, really smart, but they have to answer sometimes to trustees and boards that are just uneducated about financial markets in a broad way. And that's why they're unwilling. There's a huge bureaucracy, and they can't fight against that bureaucracy. Well, the unable are the average retail investor. Maybe has a nice nest egg for retirement, $500,000, but has no access to the tools to truly protect themselves. Mm-hmm. And they're unable, and that's tremendous tragedy. They see what's coming. They want to do something about it, but they're unable to.
Yeah. And unfortunately, a lot of the people who are in the unable category are loosely connected to the unwilling category because they're the pensioners that should be receiving the pension money that these pension funds will most likely not have.
That's right. You know, in the last stimulus bill, there was $85 billion provision to union pensions. Huh. I would not be surprised to see that trend accelerate to a level that, you know, a huge level.
Yeah. And you know, one thing I want to point out is even if someone is listening to this right now and saying, well, maybe I'm not an accredited investor, so I'm gonna have to wait for Chris's retail product to come out. You need to watch this video again and just don't really think of what to do, but more so listen to the concepts that Chris is talking about. It's not just about long vol and what do I do? How do I allocate my portfolio with a 25 here, 10, 20, 20, 20, 20 or whatever. That's a component of it, but understand the concepts of what we're talking about and layer that over what you can do. and you're going to be much better off in the long run as a result.
Yeah, that's right. And there are ways, the more you can think about this in terms of a conceptual sense, you can find ways to tilt yourself in a way that protects you against all these.
Right. Yeah, you got
because,
it.
Stagflation, we talked about rental, like, first of all, owning a home that you can afford and allowing the debt to erode away with a low interest rate is actually a fantastic, you're not owning the home for the appreciation necessarily, you're owning it as a inflation hedge and a protection hedge, because all of a sudden you've turned your living expense from variable to fixed.
Yeah,
so
right.
That's a huge part of the game.
How did gold do in deflationary, in the left wing scenarios?
So gold is very interesting. It's very similar. Actually, maybe it might be helpful to kind of look at the Dragon portfolio's performance last year and kind of break it down, because last year was so fascinating because it was actually an entire business cycle in 12 months. The way to think about this, and if I'm going to put this out to viewers, right? Don't think about asset classes in terms of artificial labels. Think about how they perform by regime. It's not about what something is, it's about how it performs in different market regimes. Well, there's something like for example, a regime of economic growth, that's when stocks do well. A regime of deflation is a regime where things like actually holding cash or holding long volatility investments does well. A stagflationary environment, rental real estate or owning real estate, multifamily real estate that you can rent out does very, very well. Or gold does very, very well in this environment. So don't think about don't categorize investments based on some artificial label. Categorize investments based on how they perform in these regimes of financial history. Study financial history and find collections of investments that perform in each of these different regimes and balance them.
Right.
That's what maintains the portfolio. And that's how you can have a portfolio that will last forever, and you'll be able to be prepared for anything without needing to predict. So you look at this theory in practice, you've got last year in 12 months, we had an entire business cycle. 12 months.
Right.
Obviously, that first quarter, January through March, was a period of deflationary market collapse. Then the period from April all the way to August, that was reflation, right? Where there's fiat debasement and reflation, jubilee. Then during the fourth quarter, we began to have the beginning inclination of stagflation. I wouldn't call it stagflation yet, but it began to behave the way that the start of a stagflationary environment behaves. And that's continued through this year. So if we look at the 5 components, the concept of the Dragon portfolio is diversification through market regime. So that first, and you have the 5 asset classes: equities, fixed income, gold. You could probably put a little bit of crypto in there if you wanted to, although we don't include crypto in those descriptions. Long ball, and then fixed income. So okay, first quarter, right? Equities are crashing. It's collapsing. The problem is that bonds are already near multi-generational lows. So you're getting some value in bonds, but not much. They're not taking much in.
Rates are at lows, so prices are at highs.
Exactly. So it's hard for bonds to give you much defensive power in that environment. They did in like 08. Gold is actually crashing during that period. Gold will crash at the beginning of a deflationary crisis.
Liquidity.
Yeah, liquidity, exactly. You sell the good with the bad. But what performs? Long volatility performed really well in that environment. It had explosive performance, in fact, so well that it actually made up for all the losses of the other asset classes and actually led to about a 11 to 13% gain in that first quarter. I'm trying to remember the exact number, but
and that's because we had Rodman on the team.
You have Rodman, exactly. So what happened? What happened? Your team is missing every shot in the fourth quarter.
Yeah.
Fixed income, which is normally your defensive player, is out injured because the rates are so low, right? But long volatility is coming in, getting you the rebounds.
Yeah.
And in the rebalancing process, it's giving you second chance opportunities to reload your scores. So the result of that is that strategies that didn't have that component, like risk parity, for example, had huge debilitating drawdowns. And the classic portfolio had huge debilitating drawdowns during that period. But this balanced market regime portfolio, 100-year portfolio, did really well. Well, then what happened is we now enter into the reflation stage. Governments go crazy. They got $10 trillion of global stimulus, both fiscal and monetary stimulus globally. We're devaluing fiat, and we're throwing everything at this problem. And lo and behold, we have huge outperformance starting in April in equities, huge performance of equities, running all the way up, and huge performance in gold during that period of time.
Yeah.
Right? Incredible performance of gold during that period of time. And that's what you're seeing in that chart. We break out the performance by each regime. Volatility is getting killed, right, during that period. At that point, vol is dropping, CTAs are not doing that great, and fixed income is just there. But that period between April all the way to August, you get a huge 25 to 30% return in that period because you were able to lock and reload, long ball rebounded your basketball,
right.
gave the ball back to the scorers in the fourth quarter, and the scorers are now running to town. Fantastic. So tremendous performance led by gold and fixed income. That's classic reflationary behavior, that you see. Well, then by the end of the summer, we begin to see a tick up in interest rates, and you begin to see some of the inklings of what we might call kind of the beginning of stagflation environment. And that fourth quarter, you began to see pressure on yields. Yields are rising, and you begin to see huge gains in commodities.
I was just going to say, yeah, their commodity trend probably kicks in. And I was going to say, especially if this went into 2021, we would really see the commodity trend kick in.
Exactly. Commodity trends up a good 8 to 9%. A lot of these commodity trend advisors this year are up a good 8 to 9% this year. It's driven by these trends, these huge trends in commodities and currencies as well, and these other aspects. But so that fourth quarter, bonds are doing badly, not very well. Equities are humming along. They're humming along. But you begin to get real strong outperformance in commodity trend, and you have slight gains for that period. So this is like a total business cycle in a period of 12 months. But like you can map this on and sit back and look at this as a proxy. You say, okay, the January to March was like the 1930s. It was like the Great Depression crash. The explosion of equity prices and gold was just like when Roosevelt devalued in the 1930s, or when Nixon devalued, or kind of the late 1990s. So we went from a 1930s deflationary crash to a 1990s speculative market in 3 months. And so it was crazy. And then really, you look at the latter part of last year or the beginning of this year, and it resembles the beginning of stagflation in the late 60s. So the point on all this stuff is it's so easy. You need to think about diversification based on market regimes. And if something's not performing, but it's not performing in a regime it's not supposed to perform in, who cares? It's diversification over a decade or by regime and not by day.
Right.
So, like commodity trend advisors haven't done well the last 10 years. Who cares? What you need to make sure is that they do well as they are now in a period of stagflation. That's what they're there for. You don't care if they're not doing well. It's like taking Robin out of the game because he's not scoring, right? Or taking Robin out of the game because your team can't miss, right?
But that's what everyone does, Chris. Everyone does that when they're putting together their portfolio. They're not starting from the point in which you're referring to. Their starting point is, what do I think is going to go up in price over the next 2 or 3 years? Oh, I think that's going to go up in price. I think that's going to go up in price. I think that's going to go up in price. boom, make sure I've got at least 5 things, and bam, I'm diversified. There's my portfolio. Because I think Bitcoin's going up, I think gold's going up, I think this is going up, this. And that's not portfolio construction. And if you're going back to blackjack, you don't have an edge there. You have no edge. And if you don't have a mathematical edge, you may get lucky in the short term. I'll give you that. But if you keep doing that over the long run, the law of large numbers is going to kick in and you're going to lose. The house is always going to win because they have that mathematical edge.
That's right. That's exactly right. And if you sit down and you are able to, if you're able to sort of understand that the sum is greater than the parts, and your edge comes from regime diversification, you can have a portfolio that is able to just perform to every market regime, as this sample portfolio did last year. Last year there was never a blip. It was steady up all the time. Yeah. So. And this is the basis of the research, is to challenge the way that we think about asset diversification. And, this is interesting because we've done it, the Dragon portfolio and the 100-year portfolio, we did an extensive research paper where we didn't cover this. You've covered it on some of the other videos. We looked at every strategy going back 100 years. It was exhausting. And there's tremendous detail on how to replicate those assumptions in our appendix. It's a huge paper, but the appendix is even bigger than the base paper. But you need to look at these things in terms of a long-term cycle and look at this framework and think about like every asset that you own. Look at your home and say, how would this perform in stagflation? How would it perform in inflation? If I own this particular, if I own gold, if I own silver, if I own this particular stock or this particular, how would it perform in each of these market regimes?
And your 30-year fixed rate mortgage.
And your 30-year fixed rate mortgage, exactly.
Most people are like, I need to go short the dollar. I'm dollar bearish. Well, do you have a 30-year fixed rate loan? Yep. Well, you got to include that in the portfolio.
And this is so hard. Like, this is why I say recency bias is a systemic risk.
Yeah.
It's a risk. The biggest risk to markets today is recency bias, because people look at the last 30 years and they assume the last 30 years will to the next 30 years. Someone who's operating based on that perspective, I think it's going to be really damaging. A lot of wealth destruction. So, if you go back and you look at this, we talk about this in the paper, like it's 1947, 1946, 1947. You're a GI. You're coming back from World War II. You got a little bit of money in your pocket. You're newly married with a little kid. And someone comes to you and they say, you've got a kid, you've got a beautiful wife. Why don't you buy a home and put some money in the stock market? And that GI might look at you and say, are you crazy? Because have you been paying attention for the last 20 years? If there was about 2-decade period where the stock market had no gains and the real estate market had no gains.
So he went into bonds right before they did yield curve control.
That's right. Yeah, that's right. So someone sitting there, a GI coming back, would be like, are you crazy? My parents were in stocks and my parents were in real estate and they lost everything. I'm just going to put my money in CDs. Well, if you had that recency bias in the mid-40s, you would have missed one of the greatest industrial booms in economic history. Right. Now the period of the 50s was a huge boom time for the U.S. Now we fast forward to the 1970s. Let's go early 1980s. You're sitting down and you're a young analyst at a firm, and you go up to your bosses and you say, "Hey, actually, you're probably a young Lacey Hunt."
Yeah, exactly.
Lacey has nailed this trade in a way that no one has.
Right.
You're a young Lacey Hunt, and you go up there and you say, "Hey, this Volcker guy is pretty serious about getting inflation under control. Bond yields are at 16%, mortgages are 25%. Let's go all in on zero coupon bonds with high duration."
Yeah.
You would be laughed out of the room.
Right.
Where have you been for the last 15 years? Don't you know bonds are certificates of confiscation?
Right.
Right? Why are you crazy? Why would we do that? That's absurd. So this is the danger. And it's the danger that creates, fourth turnings as well.
Yeah.
One generation forgets the lessons of the old generation. And there's so much damage. And I think what's so important if someone wants to preserve their wealth is to read financial history, look at your portfolio, understand rebalancing based on market regimes, and rebalance accordingly with that in mind.
Yeah, and a great place to start is the allegory of the hawk and serpent, which is the paper you're referencing that again is on your website. So guys, the main takeaway here is go to Chris's website, look at these papers, download them, and make sure you're going back to his website every single week for new stuff that's going to help you become a better investor. That's really the bottom line here.
The fun thing about that paper is we look at every asset class. And we look at that asset class.
And strategies too. Remember you said there's the buy the dip strategy. You went through all of them.
Yeah, strategies. We actually recreated various financial engineering strategies, risk parity. Like what would a short call option do? A covered call overriding have done theoretically in all these regimes. And we look at them based on all of these different regimes, and we give extensive visualizations and performance data. So it's just like, I think it's important. Like some people might read the first section of the paper, look at the appendix where there's all of this visual data, and just think about how these assets perform in these environments. And even if someone's not an accredited investor or a qualified eligible purchaser, and you can't get access to all these sophisticated hedge fund strategies, you can educate yourself on thinking about this dynamically and seek out products. And we'll have more tools coming that will help people with that as well. This paper we have coming out next week that talks about how better to evaluate portfolio or team success over individual player or asset success, I think will also help people. But this is the way you survive through this next crisis or the coming crisis. Because anyone who claims, I have my view, I think we get the stagflation leading into a big deflation, sucker punch, and liquidity crisis. I may or may not be right. If you are planning something, you don't need to be right about views.
Yeah.
It's just a matter of maintaining this diversification by market regime and rebalancing accordingly, and that will help you through this next period of turbulence. And there will be much more turbulence.
Yeah,
not out of the woods at all.
Yeah, I completely agree there. All right, Chris, I think. Boy, we've gone like an hour and a half, buddy. And it was funny too. Usually I try to jot down a list of questions, but with you, I only wrote down like 2 or 3 because I knew that once we got talking, it would there's plenty of us to go back and forth. There's a lot of room there for dialogue. No need to write down questions. That was a fantastic interview. I really want to thank you for your time. You are absolutely amazing. You're definitely one of my favorites, and I'm so glad, and I feel so fortunate that I was able to get you on the show and go back and forth here. I just can't wait to do it again soon.
Oh, I had a blast. Thank you very much. I think you're doing a great job putting out some great content out there, educating people in a way that's very accessible to some very smart people. So it's been a pleasure to be on the show, and look forward to doing it again sometime.
All right, buddy. Have a great day.
Thank you.